Swing trading strategies for intermediate Forex traders. Introduction. Swing trading is a popular trading style that lies between day trading and trend trading. Intermediate Forex traders often find swing trading appealing as it allows them to capture medium-term price movements and avoid the constant monitoring required in day trading. Swing traders aim to identify and capitalize on price swings within established trends. In this text, we will explore swing trading strategies for intermediate Forex traders, focusing on key principles, techniques, and risk management. Identifying swing trading opportunities. Analyze market trends. Before entering a swing trade, identify the prevailing trend using technical analysis tools like moving averages, trend lines, or the Ichimoku cloud. Swing traders typically align their trades with the overall market direction. Chart patterns. Look for chart patterns such as double tops and bottoms, head and shoulders, triangles, and flags. These patterns can provide potential entry and exit points for swing trades. Fibonacci retracement. Use Fibonacci retracement levels to identify potential support and resistance areas. The swing traders often enter positions near these key levels as the price is likely to reverse or continue the trend. Swing trading entry strategies. Breakouts. Enter a swing trade when the price breaks above a significant resistance level, bullish breakout, or below a critical support level, bearish breakout. This strategy assumes that the price will continue moving in the direction of the breakout. Pullbacks. Enter a swing trade during price pullbacks in the direction of the prevailing trend. This approach allows traders to enter at better prices and increases the probability of a successful trade. Moving average crossovers. Use moving average crossovers, such as the 50-day and 200-day moving averages, to generate entry signals. A bullish crossover, short-term moving average crossing above long-term moving average, signals a potential uptrend, while a bearish crossover indicates a potential downtrend. Setting stop loss and take profit levels. Stop loss. Place a stop loss below support levels for long trades or above resistance levels for short trades to limit potential losses. Traders should also consider using dynamic stop losses, such as trailing stops, to lock in profits as the trade moves in their favor. Take profit. Set take profit levels based on technical analysis, such as Fibonacci extensions, key support and resistance levels, or chart patterns. Take profit targets should offer a favorable risk to reward ratio, ensuring potential profits outweigh potential losses. Managing trades. Risk management. Determine the percentage of capital to risk on each trade and stick to it consistently. Avoid over-leveraging and manage position sizes according to your risk tolerance. Avoiding over-trading. Resist the temptation to enter multiple swing trades simultaneously. Focus on high-quality setups and avoid over-trading, which can lead to losses and diminished performance. Monitoring the trade. Continuously monitor the trade's progress and be prepared to adjust stop loss and take profit levels if necessary based on price movements and changing market conditions. Timeframe selection. Daily and 4-hour timeframes. Swing traders often focus on daily and 4-hour timeframes to identify medium-term trends and capture price swings. These timeframes provide a balance between monitoring the market regularly and avoiding constant intraday monitoring. Aligning with personal schedule. Choose timeframes that align with your personal schedule and availability. Swing trading offers flexibility, allowing traders to fit trading around other commitments. Emotional discipline. Stick to the trading plan. Adhere to the predefined trading plan, including entry and exit criteria, risk management rules, and position sizing. Avoid making impulsive decisions based on emotions or market noise. Patience and confidence. Swing trading requires patience, as trades may take several days or weeks to unfold. Have confidence in the analysis and strategies implemented and avoid premature exits due to short-term fluctuations. Conclusion. Swing trading strategies provide intermediate Forex traders with a balanced approach to capturing medium-term price movements while avoiding the stress of day trading. By identifying swing trading opportunities based on market trends, chart patterns, and Fibonacci retracement levels, traders can improve their chances of success. Implementing effective entry and exit strategies, setting appropriate stop loss and take profit levels, and managing trades with discipline are key elements of successful swing trading. Intermediate traders should prioritize risk management, emotional discipline, and continuous learning to refine their swing trading skills and achieve consistent profitability in the dynamic and ever-changing Forex market.